Yes, I'll go back. Good afternoon. Can you hear me okay? Good afternoon. Thanks for joining. We'll start. Yes, thanks for sending me assignments for feedback. Those I received, and I'll send you feedback soon. And I'll share with you all the relevant resources at the end of the lesson on our WhatsApp group as well. Okay. Okay. Today our lesson will go through our LO4 learning outcome 4. So last week, please, we discussed about our LO3 learning outcome 3, and this week we are covering LO4, and the next week, we'll do assignment discussion. So please, we'll go through in detail how we can address all the learning outcomes, where we can find the information, how we can reference, and how we can embed examples, and how we can add the sources of information. Yes, something is a lack of because we're not included in text citation and the reference at the end. So those I will give you plenty of examples. We can pick any and we can rewrite in our own words and we can add, the reference. Okay, so please, if any question during lesson, feel free, you can ask and we can go through accordingly. Hope you can hear me. Yeah? Okay, we'll start. Okay, today lesson we are looking at LO4, which is be able to interpret financial statement and make justified recommendation for business stakeholders. We know already stakeholders mean anyone who has any interest in the business is a stake. So today lesson is key focus will be financial ratio, and you already learn in the various other subject areas as well financial ratios in your previous qualification, which is one of the key topics, which is to measure the financial performance. Okay, so during our previous lesson, we will do a bit. Yes, please. Can you hear me? Okay. So previous lesson, please, we learn about IAS 1, International Accounting Standard 1, which is about how we can prepare financial statement. We discuss about four major types of financial statement: statement of comprehensive income, statement of financial position, statement of cash flow, and statement of chain equity. We discuss IAS 2, which is International Accounting Standard 2, about inventories. We discuss about, inventory should be recorded at cost or net realizable value, whichever is the lower. IS7 cash flow, we discuss about operating, financing, and investing activities. IS10, we discuss about post events adjustments, and within 90 days before signing, we supposed to be adjust. If been signed off, then of course we can't adjust it this quarter, this annual, and we can make initial all these adjustment in the next financial year. So IS16 property plant equipment revenue, and IS 36, 37, 38, goodwill, provision of assets, and the revaluation of asset, those we discuss impairment. Combination of the business, consolidation, financial statement, parent, subsidiary, associate, and today lesson key will go through and we discuss about business ethics. Yes, and we discuss these consolidated statement in previous lesson. Okay, this week, please, we're looking the financial statement you're already very well aware of, and within that, we're looking the financial ratios, and we'll go through different types of ratios, please. And this indicative content will address, all type of ratios and how we can measure the financial performance of the company. Okay, so 4.1, please interpret, the financial statement using the ratios. Of course, different people will not look only the financial ratios. Of course, maybe the ratios look good before COVID-19, the company's performance absolutely fine, but COVID-19 happened, so we have to look around the current environment as well. So when interpreting the financial ratios, it is important which we need to be look around the user of the accounts, and we need to be look around information they needed to make certain decisions. So data, information, and knowledge, and based on the knowledge they can make the financial decision. So supplier and the lender, they are very keen, and the security of their debt. The management, they are quite concerned to look around the level of profitability, and the potential user of the financial institution, implies professional advisor, investors, all these are very keen to look around the financial ratios are simply calculation which we can do based on correction of the set of data, which is normally we can always good to be provide 2 years ratios are the average within the industry. So that's, help us to measure the performance. We can look around the benchmark, each ratios, and then we can compare the performance against these standard. Yes, always try your best, please. When you're comparing the ratios, don't compare the small company with the big company. If you're saying, LTD with the multinational corporation like Unilever, then of course it's not. If you're looking Unilever and Procter and Gamble, then it's fine. If you're looking Amazon or eBay, then it's approximately fine, because even as Amazon operations slightly becoming bigger and bigger. So we have to look around these changes in the sales activities also affect, the wages, salaries, and all receivable. If the strategies of the company are, we have to think about in term of accounting standard, these, revaluation of assets in the light of, you looking at the depreciation method, those we need to be look around accordingly. Ratios of the limited use of their own, the point should be served the use of the checklist, and you need to be analyze the data and comments on it, which we'll go through. Okay, so please, we can categorize ratios. You can, different authors slightly different types of ratios, but majorly we can divide into four key areas. Liquidity ratio, liquid, anything which we can convert into the cash or cash itself. Current asset divided by current liabilities, short-term asset, short-term liabilities. And normally we can look around the benchmark 2 to 1. 2 to 1 means £2 worth of asset and £1 worth of liability. In case of current ratio is very appropriate, but it can be varies industry to industry. So please, we have to look around again within that particular industry, because a lot of business is just based on a lot of, the borrowing, short-term borrowing. So current asset minus inventory. Inventory is not liquid because sometimes inventory is hard to sell. So we have to take out the inventory. That's the quick ratio, or we call asset test ratio divided by liabilities, current liabilities. So we can look around these. Normally, one lot of analysts. So just okay. So these are the liquidity ratios, two important ratios. Then we can look around the financial position ratios. So please, we can look around interest cover ratios or gearing ratios. So profit before operation and divided by finance cost, which is mean interest. If your profit is 4 times, 5 times, 10 times, look in industry averages, look around the last year performance, and you can argue what's happened, performance improve or deteriorated. So that's, the key we need to be look around in terms of performance improve or decrease. So please, we can look around trade receivable days, trade payable days, please. When we're looking use of resources, or we call efficiency ratios, please. We can look around the profitability ratio, gross profit margin, return on capital employed. These are our operating profit, expense against the revenue, please. These also quite useful to look around the ratios. Okay. So inventory turnover, please. Use of inventory in holding days, trade receivable in days, trade payable in days. Trade receivable days should be shorter, trade payable days should be longer. So we always have a cash, in hand, so we can meet our the requirement about the cash. Of course, our liquid position will be better more. So we have to look around those. Those we need to be look around in term of and the revenue divided by total assets. So different ratios we can compare same industries, previous years, and then we can look around. Please, each ratios formulas you've been given, I'll give you a separate formula sheet and I'll give you separate ratios handouts as well. But we've been given the whole chapter. I already shared with you Osborne, Kaplan, and BPP handouts. With those, I'll reshare with you on the WhatsApp group. And those we can 3 books we can use as a reference: ACCA, SEMA, AAT, number of others. Or itself Google Scholar we can use, for the reference purposes. Of course, maybe you're writing yourself, but if the concept came from somewhere, that's, can be used as a source of information where we got it or where we initially learned the concept itself. So that's, return on capital employed, profit from operation, total equity plus non-current liability. Why we including non-current liability? Because it's a long-term borrowing. What the key purpose of it to buy the assets, like a non-current asset. That's why non-current liabilities can be linked. And the equity mean the capital, and you have the non-current liability for the investment. That's why we including that, and we calculate the return on capital employed. So please, or either you do profit from operation divided by revenue, or revenue divided by total asset minus your current liabilities, then you can find and you can calculate as well. Okay, so please return on equity. If you want equity, mean of course is shares if you want to, and then the profit after tax, because the dividend we pay after tax, not before. That's why debt and equity finance, always debt is a cheaper than equity. Always we need 60% debt, we can look around 40% equity, and equity shareholders really want more return than the debt financing, and any interest you pay on the debt is expense for the business. So there can be argument if you want to be when you're looking at gearing ratio. So profit percentage at the expense, these gross profit revenue, or we call turnover, sales revenue is the same thing. So these we use all the formulas. Expense, if you want to look around how much is the proportion of the expense, again the revenue going towards admin and going towards distribution costs, admin costs, so we can look around. Asset turnover, revenue divided by total assets. So please, these are all the formulas as we mentioned earlier. Current asset divided by current liabilities. Okay, so cost of sale divided by inventory. So we can find how many times inventory being turnover into and being sold, or finished goods and inventory, then the cost of sales in 365. So we can look around how many days inventory been, and we carry on buying and selling, and the trade receivable days, how many days we are receiving money, how many days we are paying money. So please, and the gearing, of course, high gear, high risk. If your gearing ratio is increasing, it can be, or if your interest cover ratio is dropping, is not good for the business. Let's please, we look, this is the handout is available on our Moodle as well, which we can look around. Please, we can look around Nika and Papika. We have two companies. So please, Anika is showing 45% gross profit. Papika is showing 52.5. So according to the gross profit ratios, is showing Papika is betterly performed than Anika. And then if we look, Papika, so then please operating profit ratios, we look, Anika's 9%, another is 11.5. Still is other is a better than Anika. And then please, if you look the gearing ratio, gearing 13.26, Anika's ratios came by calculating, and the figures we can find from the financial statement, which is mean financial position here, because debt and equity figures we can find from that statement. So is a 13 point, which is less risky Anika, but when we look the Papaka is quite 71.06. And when we look alternative formula, these are two formulas that are recommended by analysts, so we can use whichever you like to. It's 245 and 15. So that is according to the gearing ratio. Anika is quite a less risky company. And if we look, the return is only 7%, but look the risk is a big difference between two. Interest cover ratio is 11.6 times. Our profit is higher than, but in case of Papaka is only 3.1 times. So in that case, it's more risky than Anika. So if we look the asset test ratio 1.22, but Papaka is 0.65. So we can look around. That's is more risky company. So company performance we can compare to the previous performance, past result, previous years, same industries. Try to be overcome the problem of vertical analysis. We do companies, compare the company performance for the particular period with the performance of the equivalent company. That's is quite we earlier mentioned. The same industry, the same size, like Unilever and Procter and Gamble, are we can look around various Next and the Marks and Spencer sort of it. So that's which we can industry average. All please, if you want to be there, is quite good, so you can find industry averages. Go on the Yahoo Finance or look the mentor reports, yes, which is reports, please, that's published on industries. And we can, if you want to be in that, you can include or go on the Google Scholar, or if you want some information from Statista website, is quite good, or you want to look around ons.gov.uk that indicates inflation rate and all. If you want to embed and reference those, you can as well, so because industry averages we can, if you want to look around Yahoo Finance, yes, and that's which we can, are number of other databases where we can use them and we can add the reference. Okay, so anyone, any question, please? If you like to ask, you can. Okay, so next, ratios maybe show the particular weakness of the company. Has the business plan to deal with these weaknesses? Weaknesses is mean area of development, the area which we can develop, and we can look around, turn business around and making changes in. So please, we can look around the impact of the decisions, investing and lending the businesses. For example, profit of the business with the poor liquidity may be improved. So that's we need to be look around the prospective investors. Please help to determine the whether buy, hold, or sell. To assess the ability of the entities pay dividend, and the potential investors always help whether to buy the shares, and the lenders always looking supplier they want to look around, we give them credit or not. Customer really, if they want to buy, well, warranty or guarantee, they quite interested to look around the company's sustainability. And the government agency, they are quite crucial to paying the taxes, especially HMRC. Public is quite interested, their corporate social responsibility, local job for local people, what they're doing towards. Okay, so as our analysis in case of Anikas and Papikas, and we can look around because profitability, no doubt, and Papikas is better than Anikas, and in that case, overall, if we look the risk and return, so in that case, Anika is better. So we recommend based on the ratios, Anika is better to be then their performance is quite good compared to. So for further reading, we included some links, please, if you want, you can. Okay, so interpretation of the ratios, quite good, please, which we can, if you want to work toward the merit criteria, we can look around the solution of the current issues. Financial reporting may affect the interpretation. Of course, if changing any accounting standards, like, inventory should be value at um, if their values first in first out method are the FCO average, and if you want to, because in the past we used to be last in first out. So in management accounting we can, but not anymore in the financial accounting. That's is hugely impact our depreciation, whichever method you follow. So the value of the assets, and it can be impact, and that's a creative accountant can be look around, please. Always the standard says if any method you want to change previous year's figure, you have to reinstate. So good comparative. So always keep in mind the characteristic about the financial one of thing is a comparability, comparable figures of 2 years, and that's we have the same accounting rules and the standards that the way we calculated the previous year and this year. So otherwise figures won't be comparative. So we need to be look around these standards in the light of manipulation of the financials is commit the fraud. Like you very well aware of, these are the biggest company and the biggest fraud in the world. Enron, of course, World Telecom, Lehman Brothers, and number of others. So these are, and very creative accountant always try to be, especially Enron scandal, 3 hours movie on it. If you want to hold the book, the current asset value being increased based on the future prediction. So if the table value chair or furniture, if you're selling, it's maybe 20 pounds. Now we are saying it will be 200 pound, and we including the value 200 instead of, and mark to marketing techniques being used, and that's is being, and that's even and one number of others editors, they're not highlighted, and of course they're not sustained, and we have to look around the auditor's role. But here is the conflict because the editors is all getting the fees from, and that's maybe the major fees is coming from one of the company so big, and that's maybe there is number of threads, so self-interest may be more powerful than itself. So World Telecom scandal, so that's one of, please, all the facts and figures there, and we can look around these, and we can look around in terms of the ratios. Maybe sometimes it look good, look around the current environment, look around the future policies of the company, read in the financial statement, download, and as a financial analyst, look around, not just the financial ratios, right? The process where the knowledge of the accounting rules and manipulate the figures, the creative accounting. Yes, new standard carry on coming to address these problems. Why creative accounting, stakeholders and the market reaction related to more and more manager action and directors. That's why we not focus on the shareholders' interest. We focus on the stakeholders' interest should be protected, and the not shareholders' wealth maximization only. So we need to be look around the creative accounting used to hide the particular bad years, exceptional good years. Yes, continuous pressure on always the best, smooth out the result. Sometimes delaying the payments to look the cash flow good when accounting, and we sign off and then showing because the noise being on the public domain. How the accounting regulated, of course, that's a lot of new standards, the choices, accounting method, minimum use of judgment, estimate, sometime we look around the contingent asset and liabilities, the likelihood of, and those we can, and again is we have the standard IS we discussed, 38 and all. So please, reason for creative accounting, why we need to be rapid, steady trend of the growth and the profit rather than volatile profit and the series of dramatic, rise and fall, and we can hide it, and that's, the lot of, we shouldn't, but because the IS1 says we need to be financial information true and fair. So manipulate the profit, ties in the forecast, and keep the income boosting. Accounting policies and attention from unwelcome news. So we have to look around those. Our new legislation can be heavily impact. Maybe the figures look good, but new legislation or policies can be heavily impacting future and risk. What the strategies in place to are systematic or unsystematic risk. So some of the common method of accounting, excessive provisions like bad debts and various other extraordinary items not allowed anymore, and off the balance sheet finance, capitalized costs and non-trading, or even sometimes intra-company trading. So we technically we should be eliminate between the groups, and legitimate techniques can be implied when really we calculating these and preparing accounts. So we have to look around and look around the ethical and the different, whichever international or general acceptable accounting principle, whichever gaps you follow. So we have to look around in the light of those. Creative accounting should be used if within the application of the law and achieve, the company ultimate, the goal and increase in stock value must be benefit to company in the short run, but in the long run, but note, the misled user because that needs to be true. So please, we included a few links on, and that's, quite good to look around. And the question, please, if you want to look around, we have the handout, which is called Osborne handout 7.1 to 7.7, 7.7. These are all the questions. Chapter 7 is relevant to ratios. And if you want to pick the examples and you want to add it, you can, or any other, generic examples you want to include. That's absolutely fine. And some sources of information as given. So, yes, we mentioned Yahoo Finance. We can look around the micro environment, like at the moment, we can look around GDP growth. So we can think about, the best political, economic, social, and technological environmental factors. Maybe if the company is investing on AI or machine learning, blockchain, or others, so maybe they're not investing. That's, so that can be argued not only the financial ratios indicators for the future performance based on the past trend. So that's, which we can, and information should be true and fair in the light of accounting standards. So that's all. Anyone, any question? Yes, I have two assignments from two of you, and I'll send you those, the feedback soon. And that's okay. So next week, please, we'll go through our assignment discussion lesson, and we'll discuss, how we can address all the learning outcomes. I'll share with you the sample assignment, which is available on our Moodle page as well. If not, I'll share with you Kaplan, BPP, and Osborne handouts, and open tuition one as well, please, if you like to, whichever you like to use it, you can. And you can pick example, include, and if you want, ACC article on different topics, those are quite good. If you want, you can reference as well. Quite good to use in your. Okay. Yes, please. Anyone, any question? Hello.
Hello.
Yes, please.
Yeah. Hello. Hi. My name is Talat. I'm just actually looking for the handout for the one actually you explained us.
Okay. So handouts. What I'm going to do, I'm going to send you the Kaplan booklet. Yes,
Okay.
is F7 ACCA exam, which is called financial reporting.
Mm-hmm.
So within that, we have all the standards as well. I'll send you ACCA pocket cards. Yes, those are quite good. Yes.
Okay.
So
Okay.
if you want to use them, you can find all the standards, the ratios and things. And I'll send you BPP handouts, and I have a couple of books, which is we call AAT, which we normally use for draft financial statement unit, which is mean
Okay.
financial reporting. And
Mm-hmm.
it's mean, when we'll do next week our discussion about assignment, and then I'll refer you which example, which book, and which page, But
Okay. Okay.
within the slide, like I shown you earlier, 7.1 to
One. Yes, please.
7. So these is all about Osborne.
Okay. Osborne. All right. Yeah.
That
Thank you.
information. So there will
Thank
be all chapter activities and answers for those chapter activities.
you. Mm-hmm.
Those
Okay.
are given. If you want to use them, you can.
All right. Okay. Okay. Thank you. So we have a next week assignment discussion.
Yes. So which will go through how we can structure, where we can find, how we can reference, and
Okay.
what are the key sources we can use, and how we can embed the example in our writing, and how we can interpret the information.
Okay. Would that be our last lecture, or we have?
Yes, will be last lesson for this unit, this
Mm-hmm.
module, and then of course within 2 to 3 weeks, if you can, make your assignment and submit, then of course we'll mark and
Okay.
back, and then we'll send to awarding body. Of course, then we can sign up.
Okay. So I'm stuck, or if I have any problem, so can I send you a message or consult with you? Is that all
Uh,
right?
yes, always very welcome. Please,
Thank
we
you.
are on the WhatsApp group. Yes, you have my number there.
Okay.
And other than that, if you want, sorry, I missed, few email last week, but this is my email address, anjum@ukversity.co.uk, and you
Okay.
send me, I'll send you feedback.
All right. Okay. Thank you. Thanks so much.
You're very welcome. Thank you.
Thanks.
Thank you. Anyone else, please? Any question?
Hello.
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 Hello, welcome. Yes, please. Any question you like to ask?
First, I just for you guys from the beginning. I was just wondering, but now that I got your email, I will ask you. I will send every that I need because I've just upped my assignment today because I started this weekend. So I want to go through the assignment first. I've not even started it. While I do that, I need the and the applications, but since I'm a little lost in the if I have anything to ask.
Sorry, it's slightly, I think so, some issues in reception wise, but the way I think so, I get you. You want to ask. So what we'll do in the next lesson, we have the lesson about the assignment discussion, which we'll go through, and then anything you miss, we can send you all the recorded sessions. And other than that, next week when we'll do assignment discussion lesson, we'll do a recap, whatever we learn. And you can send me on my email address, if you want feedback. If we need one-to-one, we can book, a few one-to-one session, where whichever area you like to discuss, so we can go through those. Yes, all the resources and the recordings available are Moodle page as well. Hope so you have our VLE access as well. Uh, yes, if you have any other question, always feel free, always please ask. Hello. Yes. Uh, yes, please. Anyone else? Adnan, you want to ask something? Any question if you have? Mike, any question, please?
No, I don't have any questions so far now. Thanks for asking me.
Okay. Okay, welcome. Okay, thanks for attending, and further we'll go through next week. Please try to attend, the assignment discussion lesson, which will recap whatever we learned in the previous lesson, and we'll go through assignment brief, and we'll go through how we can address all the learning outcome and how we can structure and the sources, and I'll share with you the sample assignments as well. Okay. Thank you. Have a lovely week.
Brilliant,
Thank
sir.
you very much.
Thank you very much, sir. Have a good weekend too.
Thank you. Yeah.
Take care.
Thank you. Thanks so much.
Thank you.
Thank you, sir.